Oh, good morning, folks. We're going to be talking about a Lyft stock and their earnings. We saw earnings from Uber last week. Um, I will just say the stock right now is up 5% as far as Lyft's concerned. And I'm going to give you just a heads up. This 5% upward movement is entirely because of how the market's been reacting lately. I'll just throw that one out to you. So, I don't think these earnings are anything special. As I told you, since this doesn't have a defensive position beyond the ride sharing business like Uber does, I anticipated this company losing 50%, 50% of its revenue. I really did. So I'm just gonna say I did take a sneak peek and it doesn't look good. All right, so they put up a GAAP EPS of negative $1.46, which is missed by 13 cents. You know, not not good by any means. You can't lie. That's probably horrific numbers. I just can't lie to you. In revenue of 499 million, down 47.7% year over year. Did beat by 12.7 million. So if they didn't beat, they would have shrank 50%. But they didn't. I'm proud of them. They beat my estimates. Good job. Good job. But that's ugly numbers. I mean, you're talking about a 50% decline in revenue this last quarter, and frankly, you're probably going to see the same thing in the next quarter. I can't lie to you. But the reason the stock is up again is we had positive news on vaccines. So if that is the case, that potentially means once we mass produce this vaccine, this could normalize Lyft's business, and that's why the stock's up. Active riders were up 44% year over year. I don't know if that's really a good sign. They'd missed the consensus, and revenue per rider was down 7% year over year. So I don't know if that's really a good sign for them. I mean, it's good for more active riders, but again, revenue per rider decreased. People are spending less far trips. Here's from CEO Logan Green. Lyft's third quarter results reflect our focused execution and business resilience. We are encouraged by the ongoing recovery in ride sharing. There's not any recovery, we're lying. It's 50% decrease in revenue. And the performance improvements we saw across bikes, scooters, and fleet. I think that's pretty stupid. But we remain confident that demand will continue to return as we progress through the recovery. Don't think about that one. It's going to be a hot minute, okay? You're going to be talking at least a couple months. Or a couple quarters, I should say. But still, let's look at some more detail. We got to do it. So, revenue down 48%, but up 47% quarter over quarter. I mean, that's the recovery they want to talk about, but I just don't see it. Adjusted Ebitda loss, which is adjusted, by the way, of 239 million. So I don't know. That one's pretty rough in my opinion. That's quite a bit of loss. It could be a lot worse. The loss was 128 million in last year's quarter. So all things considered, you might have expected more. Really. So it could have been worse, I guess. Active riders were down 44% year over year, which is what I was saying. Like 44% up doesn't make sense, but up 44% quarter over quarter, but year over year down 44%. I mean it does show some recovery, but I just don't see. It's gonna be a while before you actually get true recovery. That's all I'm gonna tell you. We also have even some more details. Are you kidding me? Jeffries gives this stock a buy at a price target of $45. I don't know if I get that at all. I don't think I get that. I mean, I don't know. Maybe I'm just a downer, but maybe in a year's time I get it. Maybe price target should be a year out, so I could get it, but I just don't like the company right now in the short term. It's not going to be looking good. So as far as these earnings, we saw really everything that it had to detail there. Nothing super crazy. I do want to see actually just the net loss. There you go. Net loss of $459 million. hey, it's not Uber's $2 billion, right? So you got that going for you. That's rough there though. It's actually a little bit better than quarter three of last year though, so there is good things to say about that. And again, adjusted loss, I don't usually look at that too much because I mean, they fudge those numbers a little bit. Net loss is what I tend to look at because it's a consistent number for all companies. So, not good, which makes me want to think about this balance sheet and what could possibly happen. So, overall, total assets on this company, okay, of $4.9 billion right now. That compares to 9 months ago, in which 4 months ago, in which we had 5.69 million or billion dollars. So around a $700 million decrease in terms of total assets. Not a shocker. There's a lot to expend or a lot to spend on here, and especially with a net loss of $500 million, it's not unexpected. Now liabilities, not a shocker. They grew as well, 2.96 billion versus 2.83. Didn't grow to an extreme amount, so you have to give them credit for that. And the current liabilities actually shrank a little bit, so you got to give them a little bit of credit for that. But that does put the stockholder equity in necessarily not the best place. 2.8 billion last year or 9 months ago versus now it's at 2 billion. So you're talking in a 9-month span, you shrank this balance sheet by $800 million in terms of equity. So it's not a do or die for this company. You need to say that because they still have that $2 billion in equity on this balance sheet, and there's no doubt that they can recover. By the time they actually find business recovery, they're not going to run out of money, and they're probably not going to need to draw capital. That's my opinion on the matter. So there are positive things to think about this situation. So they could have lost a lot more. I still don't know if I like Uber stock where it's at right now. I don't think I do. I mean, I don't know. Something just doesn't seem like it's not my cup of tea. And if it's yours, that's fine. I just wish this company wasn't so. I hate to say it's one-sided because obviously they offer the scooter fleet. I mean, I think it's a one-sided industry, and that's what I don't like. I think they need to expand, like Uber has done with Uber Eats, to make it a little bit better in terms of that. I think they need some expansion. Otherwise, anything like this happens, and I'm not saying anything like this will happen again, but if something happens bad to the industry, this stock just gets devastated consistently. And I just don't like that. I mean, year to date, it's still down, right? It's down 13% still, and I think it obviously is warranted. Very warranted that it's down 13%. But I still don't like the stock. I'm sorry. I don't like it in the short to medium term by any means. I still hope you enjoyed this and you have a good one.